So good afternoon today, Advanced Corporate Finance, the presentation on the assignment. Now online available, KOMD Silva, Vithanage. Hello, are you hearing?
Hello.
Yeah. Are you ready
Hello.
to present?
Yes, sir.
Okay, right. So that
Yes,
you
sir.
can,
Yes.
that present your own, PowerPoint slides.
You can upload your slides from your side and you can present. And now I saw that KOMD Silva has already uploaded slides. So if you are ready, you can start presentation.
Yeah, yes, sir. I'm KMD Silla.
Please
It is
share your slides first.
sorry.
Please share your slides first.
Wait.
Hello.
Okay, I can. I'm unable to open the presentation.
Now you have already, I saw that you are uploading.
Yeah, but
Go to the content, manage content, and there, okay, I'll open from this side then. So there you can see your presentation, right? So click on the first icon there. So then your presentation will be shared with us. Okay, then so we'll upload from this side then if you have trouble. Okay. Now you can start. I think you can see the slides.
Yeah, I can see the slide, sir. Can I start?
Yeah, start.
Yeah. As a financial manager, I got a new project at Yala, the construction of new hotel naming Yala Safari under our company. So my objective of this feasibility report is to determine the marketing and financial feasibility of the hotel in Ayala, to estimate the cost of the project, to calculate the cost of capital and payback period of the hotel, to do a profitability analysis, and finally to decide whether to invest in the project of information available regarding the hotel industry in Sri Lanka and from the company itself. Limitation of this feasibility report is all the calculations done based on the assumptions and approximation which are subject to be changed. Uh, uh, when we consider about the place, about the area, Yala is a tourist area where both local and foreign travelers are attracted. Yala is mostly famous for Yala National Park. Not only that, there are other 6 national parks and 3 wildlife sanctuaries situated near the Yala. The Mattal Airport Southern Highway created easy access to Yala. And also the ancient temples of Sis and Hattaragama are also situated in the nearby. So the hotel which we are going to construct is situated at Palatupana, near to Palatupana Salton, 2 kilometers away from Yala National Park, and land consists of 10 acres and will be consist of 30 rooms. There are so many competitors in the area. Elephant Ridge Hotel, the Safari Hotel, Peacock Beach Hotel, Jet Queen Hotel, Chantika are some of them. As this is a hotel project, the marketing strategies will play a main role in the business process. The company have to identify the correct marketing mix to achieve the best return from the hotel. Especially the promotion campaign will be more benefited to this project to become successful. Under marketing strategies, place, we have already discussed about place. Product, the hotel will be consist of 30 rooms, car parking area, bar, coffee shop, room services, telephone in all rooms, TV with channels in all rooms with AC, restaurant. Promotion will be done by personal selling, advertisement, sales promotion, public relations. Price, the most important fact which will decide the consistent of the hotel or not. The pricing strategies will be discussed later. Analysis of the competition. As we discussed earlier, there are many competitors in this area who are well established within the area at the moment with an occupancy rate of over 65%. I have showed it there. The occupancy rate is the factor which determines the revenue of the hotels. It can be derived divided by total number of rooms. Average room rate is the selling price of the hotel, which can be derived from room revenue divided by number of revenue rooms. Now we will look into the financial feasibility. Financial feasibility means to find out whether the project is financially viable to open in Yala area under financial prospects. According to the engineer's report, the total cost of the hotel is 275 million. I have given the details. Annual average room income. The predictions have been done on the full board basis. In the hotel, we are planning to have rooms under double and family categories. The double room estimated charge is 19,500 and family room estimated charge is 25,000. For forecasted purpose, we put 50% weight for two kind of rooms and take an average room rate at 22,250.
Hello?
Hello?
Yeah, can you move the slides from your side? Hello?
Yes.
Can you
Yes,
move
sir.
your slides?
You can move your slides from your side.
Yeah, I am doing it, sir.
Okay.
Actually, I am doing it and doing the presentation. Can you hear me, sir?
Yeah, so we can hear you.
But we can see that you are moving the slides.
Yeah. Whatever
Actually,
that
I
you
am moving the
whatever you
slide
are
when I am.
explaining. Okay.
Yeah, I am moving the slide when I am explaining it, sir.
Right, go ahead. Now, where are you now?
I am in the slide number 7, annual average room income.
Annual average room income.
Yes.
What is this?
Okay.
Okay. Okay, go ahead. Hello?
So if do you want to mention the slide number when I am presenting? No.
Yeah, this is slide number 7. No, please mention the slide
Yeah.
number and then you explain.
Okay, sir.
Okay.
Yeah. Average annual average room income done under full board basis. In the hotel, the rooms can be given under two categories, double and family. The double room estimated charge is 19,500 and family room estimated charge is 25,000. For forecasted purpose, 50% weight given for two kind of rooms and take an average room rate as 22,250. Based on that, we can come up with the annual average room income of 243 million. I have mentioned it in the slide. I am moving to the next slide, sir. Calculations of cost of capital. The company is going to finance the project from its equity. Therefore, cost of capital calculated using capital asset pricing model. We come up with the cost of capital of 12% for the project. And slide number 9. The assumptions made under forecasting of financial statement. The revenue determining factor in hotel industry in room occupancy rate. The break-even room occupancy rate is 50%. Annual room income growth rate is 10%. Cost of sales 30% of room revenue. Annual growth rate of employees cost is 8%. Annual growth rate of marketing expenses is 5%. Annual growth rate is maintenance expenses is 3%. Depreciation method straight line. Here I have forecasted financial statement under three main scenarios: base scenario, worst scenario, and best scenario. And for worst scenario, I use occupancy rate of 30%. For base scenario, I use occupancy rate of 50%. For best scenario, I use occupancy rate of 80%. For each scenario, financial forecasted income statement, forecasted balance sheet, forecasted payback period, forecasted NPV and IRR calculated for coming 5 years. Next slide. There I have mentioned the forecasted income statement under worst scenario. Under this scenario, the project is end up with a PBIT of 5 million. Next slide, I have shows the balance sheet and cash flow statement. And slide number 12, forecasted discounted payback period and NPV and IRR. Under this scenario, the NPV is minus figure of 165 million and IRR will be minus 142%. and payback period is not within the 5 years. The next slide, forecasted financial statement under base scenario. Here, the project will be end up with a PBIT of 55 million. The next slide I have shows the balance sheet and forecasted cash flow statement. In slide number 15, forecasted payback period under base scenario, the project is end up with an NPV of minus 18 million and IRR rate of 4.41%, and payback period is not within the 5 years, but it will nearly 5 years and 4 months. Slide number 16, forecasted financial statement under best scenario. Under this scenario, project will be end up with a PBID of 161 million. And next slide, forecasted balance sheet, forecasted cash flow statement. Slide number 18, forecasted payback period under best scenario. The project will end up with the NPV of 201.51 million and IRR of 55.76%, and payback period will be 2 and 10 months. Conclusions. There I have put all the slide number 19, conclusion. There I have put all the forecasted figures in the summary format. Under worst case, PBIT for the last year is 5.16 million. Cash flow is 160 million minus figure, and NPV is also that. And IRR will be 142%. Payback period over 5 years. Base case, PBIT for last year is 55.1 million. Cash flow and NPV will be 18.89. IRR is 4.41%. Payback period is 5 years and 4 months. Under best case, PBIT for last year is 161.21. Cash flow is 201.51 million. NPV is also same. IRR will be 55.76. The payback period is 2 years and 10 months. Based on the worst case, the NPV is negative and IRR is less than cost of capital. The payback period is over 5 years. Under the base case scenario, the payback period is 5 years and 4 months. It also generates a negative cash flow, and IRR rate is also less than cost of capital. In best case scenario, the payback period is 2 years and 10 years. It generates a positive NPV of rupees 201.51 million, and the IRR is also greater than the cost of capital of the company. Therefore, it indicates under best case scenario, the company can recover investment within 3 years with an IRR of greater than the cost of capital. Accordingly, if company decides to invest in this project, hotel have to use marketing strategy to increase the hotel's occupancy rate around more than 60% to recover before 5 years. Based on the above finding, it is recommended to invest this project by the company with proper marketing strategies to enhance the room occupancy rate of more than 60%. Thank you, sir.
Okay, Ms. Silva, now several questions. So why that you have decided to do the this what if analysis or the scenario analysis by obtaining worst case, best case, and base case?
To get an idea about the what the hotel have to be what is the rate, what is the occupancy rate the hotel have to be maintained. Because in the hotel industry, occupancy rate is the rate which determine the revenue, sir.
Okay. But basically, for what purpose that we are doing? I am asking, some conceptual question. For what purpose that we are doing this, that what if analysis or the scenario analysis?
To determine the forecasted income.
No. It is why this is again, risk in another term. So there may be some estimation, what is called estimation error. So that forecasted figures may not be corrected always. So therefore that we do the scenario analysis by obtaining different scenarios. So then that again, the second question is that the calculation of the income, I mean occupancy ratio that you have taken in one slide, what is called 30 days per day income, then that you have multiplied by 365. Is it correct then?
Yes, sir.
How it
Normally
is correct? Yeah, explain me that in the
actually the hotels are not hotels are open all the years, sir.
That's right. But you
That's
have
why I
multiplied
said
by 30, no? 30 then into 365. So what does it mean? 30 rooms, right?
yes.
So you are not clear, no, what you are saying. 30 rooms,
Into
then
305 days.
365 days in hotel is operating.
Yes. As if that hotel is continue all the years, sir.
Okay.
And Miss Silava, how did you calculate the beta? When you use the calculator mean, you have to get the beta,
Yes.
right? So calculate the beta.
As this is a reputed company, I assume this is a reputed company, and from stock market, I got all the five-star hotels are maintaining average beta value of nearly this value, madam.
Beta value of?
Nearly less than 1, plus 1.
No. She asked that how did you calculate cost of capital? When you are calculating cost of capital, there is a beta value. So what beta value that you have assumed, or how that you have obtained the beta value? That's riskiness of the particular company, no, this company.
Systematic.
Yeah.
So how did you calculate it? What is the rationale behind it?
Yeah, actually this is, I assume this is a reputed company.
Okay, you assume reputed companies. Okay.
The assignment is also given that this is a reputed company, sir.
Yeah. Oh, okay.
Then I go to stock market and share.
No, that
Find out
answer
that
is that you are not, that clear. No, answer is that you need to obtain.
no, all the five-star hotels have a beta value of less than 1%, sir.
That's right. But that we are asking that the exact answer would be what? You are not telling that, no. Exact answer is that the beta value of a comparable firm. That is the answer. Comparable firm. If it is this your project, say this hotel is a hotel X. There are another, that ABC 3 hotels. So that what are the, that say beta values of those 3 hotels? Then comparable firm. So if the hotel A, right, can be compared with that this particular project, then that you are taking that hotel A's beta value for this calculation. That is the beta value of the comparable firm. Then that when that you are that, let's say I'm in the worst case, right? So one more question, very fundamental. Now you have obtained that say you have divided the analysis to the that 3 segments: base case, worst case, and the best case. Now, so what is the deviation? What is the deviation when you are obtaining forecasted figures among this that 3 scenarios?
actually 50%,
What? Yes?
the 50% taken as base case from the actually from the internet, the information available in the internet, that the 50%
For the base case,
is the,
50%.
yeah, 50% is the norm, for hotels to maintain a break-even point. At least they have to maintain a 50% occupancy rate, sir.
That's right. So
Huh?
my question is very clear, right? So let's say 100%, say in simple way, if I am putting it 100% is the base case, right? When you are doing scenario analysis, I am asking, so what is the let's say lower bound and upper bound? That is, upper bound is best case, lower bound is worst case. So I'm asking very simply, so what is the that I mean deviation if it is the base case is 100%, if you have done this that authentically? Yes, are you clear what I am asking? Hello?
Yes, sir.
Yeah, I'm asking very pertinent question. If you have done this, you must have clear that I'm asking the variation. If the 100 is we assume as base case, so then best case, right, upper bound, and worst case lower bound, what is the deviation? Let's say in terms of sales. No answer.
I'm not be able to answer it, sir.
Yeah, that you need to refer to the that of course, textbook as well. Everywhere it's that 5% deviation, 5%, not 50%, 5%. If it is 195, 105, and like that, so that then that you need to estimate the values. Depreciation you have made that then estimated income statement. So depreciation, do you add or deduct? In the
Huh?
yes, while calculating cash flows.
While calculating cash flow, I had added, sir.
You have added. Okay, that's right. Yeah, here while calculating cash flows, you have added it. Right. So here NPV is negative, IR also negative. Am I right? Hello.
Yes, sir.
So then what would be that overall conclusion?
If the company decided to invest in this project, company have to maintain occupancy ratio of 80%, sir.
85%.
80%, because
Huh?
under base, I have taken 80% as best case. For my calculation, worst case and base case or both end up with the negative value of NPV and IRR of less than cost of capital.
Okay.
Therefore, company have to maintain a occupancy rate of 80%.
No. You tell me, that in terms of decision criteria, how do go for selecting the project NPV, not the occupancy rate? So occupancy rate is something else, and the NPV value is something else, right?
Can you repeat the question again?
Huh?
Can you repeat the question, sir?
What I am asking, very simple question.
Uh-huh.
Not the occupancy rate. And so what is the, whether this, under these three scenarios, did you find, that NPV becomes positive?
Yes, sir, under best case.
On the best case. Okay.
Yeah.
Then what is the occupancy rate under the best case?
80%, sir.
80% of the rooms. It means that 30 rooms, 80% means that 24 rooms. Am I right? You tell me.
Yes, sir.
So then what is the use of, that then overall, that, I mean, how do you defend this, overall validity of the calculations to take a decision as a finance manager? Yes. In case that you have obtained forecasted figures, no?
Yes.
How do you justify this, that forecasted figures are, just close to the reality, if I am asking? It means that I am asking very simple way, what is the basis of obtaining projected figures?
Not be able to answer.
Okay. Okay. Right, so thank you very much. So anyway, that you have to be clear when you are doing the presentation. So whatever that you have done. So anyway, that we appreciate you the effort. However, okay.
Thank you very much, sir.
Right, thank you. Vithanage. Huh? Ready to present. Copy and paste.
Vithanage, are you ready?
Yes, sir.
Okay, now can you share your presentation?
I uploaded, sir.
Hmm? Vithanage, the slide you have uploaded contains the name DANA Kumarasiri.
No, that's not, sir. 028. That's my student number is 028.
There are two. No? Okay.
Yeah.
Okay, Vithanage, now you can take over as presenter. There is a button at the top called take over as presenter. Right, okay, now you can
Yes, sir.
start presentation.
Yes, sir. To identify that basic theories of that advanced corporate finance, I have decided to select a project which is under hotel sector, because now the hotel sector is very emerging sector in Sri Lanka now. And the assumptions I have taken up for this assignment. So the sector, as I mentioned earlier, the hotel, the initial investment was 5 million. This is actually the full board rate currently, the going rate of a 5-star hotel in Sri Lanka. So I hypothetically decided to have a 49% average growth of occupancy over the period of 5 years. The variable cost per room is 8,500. The GP margin is 75%. This is actually the industry trend. I have taken the proxy company as that Citrus Leisure PLC. For they also they maintain that 75% of GP margin. For the purpose of fixed cost, I have taken that 900,000 per annum. So in my income statement, the number of rooms I have started with 100 now. So after 100 at the first year, so it has been grown to 149. That's the occupancy growth. So sales, according to I have taken by multiplying that 33,000 per room. So variable cost also accordingly. So the gross profit all the time I have maintained that 75%. So the fixed cost also I have as I mentioned in the earlier 900,000 per annum. So the depreciation, the cost is, the initial investment is 5 million. So that has been depreciated over the period of 5 years by 1 million each. So the interest, this is actually based on the capital structure. Capital structure coming on that number 8 side. So the tax I have considered as 28%, which is the prevailing the tax rate of Sri Lanka. So when you consider about the pro forma balance sheet, the investment I have taken that in year 0, 5 million. That means the initial investment. So that has been depreciated over the period of 5 years and 1 million each. So the net book value I have taken as the non-current assets, the total of non-current assets. So the cash that is basically based on profit after tax and doing some adjustment that to interest and the depreciation. I have taken this cash balance, which is coming under slide 8. So the equity and the bank loan, as I mentioned earlier, this is the capital structure, 40% and 60%. Based on that, I have prepared this pro forma balance sheet. So the computation of cost of capital, basically the proposed capital structure, I decided to have the equity of 60% and debt of 40%. So the WACC computation, basically the equity capital, first I decided to have a debt capital of 15%, which is the now the average weighted lending rate of Sri Lanka now currently going at 12%. So I just give a 3% premium by to incorporate that debt to incorporate that risk. So 1 minus T adjustment I have done. So the cost of debt came around that weighted cost came around 4.32, and the equity also, since I have taken the debt capital as 15%, I just give a premium of 4% for the equity holders, and thereby ended up with 15.72 the weighted average cost of capital. To incorporate the risk to the basically the discounting rate, I decided to have a sector beta value. So I have taken there are around a couple of 20 companies in the hotel sector. So I have taken all the companies and identified the beta factor. So average beta of the whole that hotel industry ended up with 0.68. That means, which is less than 1%. That means actually this is less volatile than the return of the market. So I couldn't find any risk of investment of that particular hotel industry based on that sector beta value. So I decided to have, as mentioned in the previous slide number 5, I decided to have that 15% 7 to that initial weighted average cost of capital for the purpose of discounting. So when it that's what I justify here for the purpose of incorporating risk to the projected cash flows. Industry beta has been considered as the above and ended up with a positive value of 6.9. That means the volatility. So I decided to maintain with that discounting rate as it is. So when you're talking about that net operating cash flows, this is basically starts with earnings before interest and taxation. So I did that adjustment to depreciation and tax. So net operating cash flows came as mentioned 1.4 million, 1.6 million, 1.8, 2 million and 2.3 million. So based on that projected cash flows, I arrived to net cash flows as mentioned here. So then we came to that criteria, that evaluation criteria. Basically, I have considered that payback period. So when we consider about that payback period, this total investment of 5 million we can cover around 3 years and 0.4 months. That means around 10 days. So the net present value analysis also, it has ended up with under the 15.72. Net present value also 953,000 positive value. Then for the purpose of internal rate of return, that's the internal rate of return is the basic theoretically rate at which the NPV becomes 0. In that case also internal rate of return ended up with 23.23. That means we have used the rate of 15.72 mean if we discount that 15.72 rate, definitely it should be ended up with that positive value. That's what the result of here. So internal rate of return also that 23.23 in the case, that is also the acceptable project. So under the decision criteria, since all the payback period, the net present value and the internal rate of return, all the criteria provides that says that this is the viable project to invest. So it is recommended to go ahead with that project to increase the value of the shareholders. That's all about it.
Okay, Mr. Vithanage. Now this project,
Yes.
again now a hotel project. Now you have taken 5 years for the analysis,
Yes.
right? Hello?
Yes, sir, yes.
Yeah, 5 years. Now my first question is that now you have taken that to calculate the income, number of rooms available in the first year 100, second year 109, third year 119, fourth year 133, fifth 149.
Yes.
Right? So then that
Yes.
when the fixed asset is there, the rooms are increasing, like that. So apples are coming out from the tree.
No, sir. Actually, by incorporating that the occupancy ratio also, I have taken this average occupancy with that room occupancy.
Okay. Average occupancy. So how did you calculate average occupancy rate?
Average occupancy hypothetical I have taken it because that with the environment of Sri Lanka, I decided to have this 49% growth by referring some annual report of that hotel sector also. They predict that around that 30 to 60% growth can be expected.
Right. Now one more question. Now let's
Yes,
say
sir.
now you have that again taken the hotel industry Vita values, and you said that to calculate the cost of capital, firm's cost of capital, you took the average Vita. So how
Yes,
do you
industry.
justify this that average Vita? Is that correct?
Yes, average beta, sir. Now we have to consider that hotel sector average beta because that beta represents that systematic risk of the market. So
No, that's
that
right. But average
0.6
beta,
yes.
I mean, obtaining average beta is wrong. You cannot average the beta.
Yeah, there are some companies which has 2.7.
Yeah,
Anyway, that
otherwise
you cannot average it. You can average mathematically, but what my
Yes.
argument is that it is not accepted for the project analysis.
All right.
You understand?
That means
I
we
mean,
have, yeah. That means all right. That means we have to take that one of companies beta, right, as a proxy.
it means that it says always take the beta value of a comparable firm to this firm.
All right, based on at least on market cap.
Comparable firm in the sense
Right.
that firm size, right, measured through the sales. You understand?
All right.
And
Yes.
assets base and like that. So we need to look for a comparable firm to this one, and that comparable firm's beta value will be taken for the analysis. That is the correct way of doing it. If you are
Right.
going to average the beta, that is wrong. Beta never get average.
All right. Okay, sir. So, how that Colombo Stock Exchange have taken that average sector beta, sir? How did they take it?
No, that is that I mean not the average sector, not the average sector beta. I mean, so they have calculated. I mean individual company beta values, as you have uploaded to these slides. You see,
Yes.
not the average beta.
All right. That means the industry beta we can't take it, right?
No,
All right.
no. Beta, what by definition, beta is what? Riskiness of the particular company. That is the simple definition too. Riskiness of this project, this hotel project.
All right.
So therefore, riskiness cannot be calculated in this case because this that I mean newly commenced project. So therefore, you need to take beta value of a similar company. Let's say comparable similar company.
Right.
You understand?
Right, sir. Yes, got it.
Right.
And Vithanage, you have taken cost of capital as 15% for the throughout the project, right? For the throughout the period, it is 15%.
Yes,
Is
ma'am.
that
Yes,
right?
yes. Based
Cost
on
of
yes.
debt capital.
Debt capital also, madam. That the capital structure. I assume that the capital structure will not be changed during the period of the 5 years.
Yeah, that's right. But cost of debt capital?
Cost of debt capital, I have taken 15%.
15%. On what basis?
15% at that means, madam, by considering that weighted average lending rate of the prevailing market is around 12.5, so I just give a premium of around 2.53%.
Mm-hmm. So did you consider the market other factors like inflation, interest rate changes and all even in the past?
For that factors only I have given that 3% margin. That means basically that central bank has published that AWPLR. Based on that, I just increased from 3 to 2%, 5% for that factors, that inflation and all.
Right. What was the cost of equity?
Cost of equity also, madam, I have taken as 19.
19.
Yes, 19%. That also I have gained a premium of, because for taking the additional risk of equity holders, I have given that 4% premium for that also.
So according to your calculation, so what is the decision of that time in these hypothetical figures? You need to prove.
Yes,
of course, the decision
yes.
criteria you have written, but that I don't see that strong argument to go for the project or reject the project or whatever it is.
Yes, sir. This is actually, as you mentioned, this is typically based on the cash flows prediction. As long as we can predict the cash flows correctly, and also if we can discount appropriate rate, so that means the projected cash flows are more accurate. So based on that only, sir, I am giving that conclusion.
So then, did you take depreciation amounts? Yes.
Sorry, sir. Sir, yes, sir, yes. Depreciation I have taken.
How did you obtain this IRR value? 23%. Tell me the calculation.
Yes, sir. Calculation in the slide number 10. I have used the 25% for the purpose of discounting again, because we have to take that lower rate and higher rate. Based on that, I have substituted that formula and ended up with that 23.23. That means 15 point in slide number 10. That calculation is mentioned.
We can't understand that what is 10. Calculation I see, but that question I asked, that this calculation minimum, what is called NPV, this one, and thereafter, so numerator is absolute sum of NPVs, NPV values under two discount factors, and
yes, sir. Yes.
Am I right?
Yes, sir. In slide number 10, that IRR I have taken it as 15.72. That means the used discounting rate for the purpose of getting that positive value NPV, plus as the 953 is the NPV of that 15.72. So 953 minus that 224 is the negative value I have taken by discounting the same cash flows by the rate of 25%. So that multiplied by the difference of that discounting rates. That means 25 minus 15.72. From the Excel also I confirm the same answer, sir.
Okay. Okay, right. Thank you, Mr. Vithanage.
Okay, sir. Thank you.
Thank you. Next, PMD Swarnalatha. Upload करना करो, huh?
Who the others? What about others? Swarnalatha and the other Vithanage, Mr. WVDD Vithanage. Are you ready?
Hello.
Yes. Are you ready to do the presentation?
Hello, sir. I'm Deepani.
Yes.
Hello.
Deepani.
Can you?
Yes, Deepani. Are you ready?
Yes, sir. How can I have uploaded my presentation and as I'm in
No.
LMS.
It's better if you can upload it here. So there is a button called present at the bottom. Are you using a computer or mobile?
So I'm using laptop.
Okay, then in your Skype for Business window, there is a icon just next to your mic icon, like a computer
Yeah.
monitor.
Yeah.
Can you find it?
Okay, sir.
You click there
Okay.
and go to present PowerPoint files and upload your PowerPoint file there.
Present PowerPoint files.
Yes.
Okay.
And browse and upload your file and then take over as present at the top. You can click on take over as presenter button at the top.
So I can't see my presentation.
Okay, then hold on please.
Okay.
Now
No.
you are doing okay. You take over as presenter.
Okay. Shall I start now, sir?
Yeah, you can start.
Good afternoon, sir. I'm Deepani. I'm doing this presentation using my working place. Then I have suggested my proposed project to my working place. Then first of all, I have analyzed my present existing business. My present business is hello.
Hello, yes, go ahead.
I have suggested my project to my working place, sir.
Okay.
Then I have analyzed competency and present background of the company. Hilanka is my companion. Presently, it is the leading footwear and leather product retailer in Sri Lanka, and presently we are having 8 number of showrooms in Sri Lanka.
Right, okay.
Our company vision and mission I have stated here to
No
be the
problem.
most.
Go to the financial analysis.
Yeah,
No
okay.
need, Okay.
My proposed project plan is the set up 16 retail stores, retail showroom in. Set up 16 retail stores, retail showroom in highly potential market towns. I have analyzed on that step by step. I have analyzed proposed task, operation hours, and products.
and how to manage suppliers and management strategy of achieving and
Now
marketing
go to the
achievement.
financials, right?
Okay.
Go to
Okay.
the financials.
Here, first of all, I have analyzed my financial statements. Activity plan is like that. 3 showroom, I hope to invest 3 showroom in year 0 and 4 showroom in year 1, 5 showrooms in year 5 and 4 showroom in year 3. My revenue pattern is 50% from first year, then 50%, 100% in second year onwards. Here I have analyzed cost per showroom and fixed asset. I have analyzed fixed asset which want to run the showroom. Showroom handling cost, here I have analyzed showroom handling cost per month. Investment pattern and revenue pattern like that. Then I have analyzed my projected financial statements.
Oh, show us, explain that. You are running
Projected
now.
financial. Yes, sir. Projected
Why
financial
you are running?
statement.
Slowly explain it that what you have done.
Yeah. Projected financial statement like that, sir. Revenue pattern year 1 to year 5 I have analyzed 69, 227, 430, 632 and 720. Our expected GP margin is 35%. And I have analyzed admin and marketing expenses, depreciation, profit before income and tax rate is 40%. I assume 40% tax rate, and then after profit after tax 5.89 in year 1, year 2 19.70 and year 3 37.45 and year 4 55% to 3. Then I have analyzed this is the basic ratio we are expecting to get this project. Projected balance sheet is like that, asset fixed asset and net working capital. Then I have solely finance from equity. Projected depreciation schedule is like this, and projected operation cash flow statement is like here. Then I have evaluate project by using project appraisal techniques such as payback period, net present value calculation, IRR calculation. Step to do the project evaluation is, firstly I have analyzed operating cash flow statement for the 5 years. Then I have calculate discounting factor for the company, and I have applied capital budgeting techniques to evaluate the project. Estimated cash flow statement is investment figures I have taken from previous slides, and operating profit also same I have taken from it also from the previous slide. And net cash flow is first 3 years minus cash flow and and year 3 onwards positive cash flows. Then I have calculated cost of capital for the company. So only this project is used equity capital. Then I have used this for the CAPM model. Risk-free factor I have taken 9% and risk market rate is 13%. I have assumed it 9% prevailing treasury bond rate is around 9.5. Then I have taken 9%, and current market interest rate is 12 to 13. Then I have taken 13%, and risk premium is 4%. Then 4%. Beta factor also I have assumed 1.5. Cost of capital is 15%. Then I have analyzed payback. My project evaluation techniques is discounted payback period. Payback period is also 4 years and 9 months. It gives positive cash flow. Then I have analyzed net present value. Net present value also 42.35, and IRR calculation is 34.07. Based on the payback period calculation, total investment on the 16 showroom will be recovered. And no need further investment. And based on the NPV calculation, NP value is positive, and in order to that project can be accepted, and IRR also higher than the expected required rate of return. That is the conclusion of my project. Thank you, sir.
Now this, thank you for the presentation. Now, tell me this one that you said, this is for the, say, footwear manufacturing, where that you are working.
Yeah. Yes, sir.
So then, you have taken estimated cash flow statement, net cash flow, right?
Yeah. Yeah.
Okay. Now, how do you justify that net cash flow values are the values for evaluating a project? How do you justify? Simple question.
Net cash flow value. That means future benefit. We are analyzing using net cash. That means cash outflows and result of cash outflows and cash inflows.
No, Ms. Swarnalata, you are incorrect. No, because when you are doing the project analysis, so you have to be clear that you need to. We have given in the assignment. You need to project or forecast the future values. Future values based on whatever the that number of that time in footwear pairs that your company is manufacturing. You understand?
No, retailer, sir. Retailer.
Retail, okay. Anyway, retail.
Yeah.
So then that anyway that you need to project sales value, no?
Yeah.
Right? From the sales value, then what if you are retailing, then that you need to obtain what is called that as we have discussed in the previous semester as well, what is called earnings before interest and taxes. That is the first, and thereafter you need to make the adjustments, right?
The earning, I have calculated earning before interest and tax, and then I add back depreciation to the earning before tax, interest and tax.
Okay, then after, okay, you added back the depreciation.
Added back yeah, sir.
Thereafter,
added back
you are right. That tell me, that next that what we have done.
Cash.
Huh? Next, what you have done?
project
You added back the
profit
depreciation
yeah,
made. Okay. Thereafter,
I consider it is as the
no,
cash flow.
no, that you need to assume tax rate
Cash
as well,
flow.
no?
Okay.
Huh?
40% tax rate.
Then that throughout the
40%.
presentation, so you didn't that talk about what is called operating cash flow. We always emphasize the operating cash flow for the project, not the net cash flow. No?
Here I have calculated sir net cash flow.
Why is that? You justify. Why net cash flow?
Here investment is there sir. That is operating cash flow. That is profit. That cash flow get from operations.
Okay.
Initial investment also we have to consider here sir.
Always the case, no. When you are doing project analysis, initial cost that you have to be considered, no.
Yeah.
So then,
Initial investment cost I considered as a separate cash outflow. Operating profit I consider separately.
no. You are, that now telling something different now. No, you are not clear that what you have presented.
And you're going to invest only the equity capital, right? Your investment, how would you find money for the investment?
First, in first three showroom we are investing from equity capital. Then we can finance from our operating cash flows.
That's 37.7, 24 a year. Really big guy.
Hmm.
So what is your conclusion that you have got NPV minus 42 something, right?
No, madam. Plus NPV positive 42.35.
Okay, so what is the conclusion?
Conclusion is based on the NPV calculation, NP value is positive, and in order to that project can be accepted.
Did you calculate payback as well?
Yes, sir.
What is the payback?
Payback.
Where is the calculation?
Discounted payback period is
Okay.
here.
Discounted payback.
Yeah.
Not the that traditional payback we need. Discounted is something else, no?
Yeah.
Huh?
Here.
What is normal payback period? The first time I am hearing that normal payback period. Payback and discounted payback. What is normal? All are normal, no. Otherwise it's abnormal.
Swarnalata, have you taken beta value? Have you considered the
Beta value? Yes, ma'am. Yeah.
How did you get that?
That is assumed beta value.
On what basis?
Yeah.
What were the assumptions?
1.5.
Now I have a final question that whether is this that your actual project in your that the place that you are working?
No, sir. Hypothetical
Huh?
project. This is not actual, but like we hope to invest a project like this. Then I have analyzed these figures.
Huh?
This is not the actual. This is not the actual scenario.
But don't do in this way, so that your whole business will that put into the waters then. Right, this type of investment, because the analysis is that somewhat I know that very complex that what you have done. What we need to see in an assignment where that you have this is the one of the learning outcome sessions. No, we need to see whether that you have learned the proper way of doing the project analysis, right? That's why if you have that understood very well, In the first case, we wanted to see that whether that you have calculated projected financial statements, no need of a balance sheet. Then,
Okay.
then and there, net profit after tax, what after that obtaining no PAT, then that you need to show the operating cash flow, right? Then once that you have obtained the operating cash flow, then that you need to see that any other working capital investment is there. Then that you need to assume lifespan of the project, whether it's for 5 years, 10 years or so. Then you need to anticipate if there are any scrap or terminal value. You understand? Then thereafter, so final that operating cash flow that you need to show. Once that you will have the figures of operating cash flows, then you apply what is called that traditional the payback period.
Payback.
You understand? So but
Yeah.
we haven't seen this process here, sequence. That's what our assignment meant. Did you follow the lecture sessions?
Mm,
No.
yes, sir.
Huh?
Some extent. Some extent I have.
Seldom, not often.
Yeah. Often yes,
But that pay you attention. Go back to the slides that we have done. We have
Yeah.
done very clearly in the stepwise way to make you understand, right?
Okay.
That sort of fundamental knowledge is important for preparing that this kind of a project proposal. Okay then. So
Okay.
do we have anything to ask? Okay, right. Thank you, Swarnlata.
Okay. Thank you, sir.
Next time we hope that you will do the best presentation.
Okay. Thank you, sir.
Okay, next, Kumarasiri, are you ready?
Yes, sir.
Okay, please upload your presentation here. Have you uploaded?
I have, yes, sir. 029 already uploaded.
No, I mean, did you upload your presentation here to the live session?
Yes.
Huh?
Yes. ACF 2016 029. Shall I upload it again?
Ah, right. Okay. Now, okay, you take over as presenter,
Okay.
right? Okay, you are ready?
Yes, sir.
You,
But
there is a button
this is
called
not
take over as
my
presenter at the top, right?
presentation.
Hmm? Then you go to this.
Yeah. I have already done this presentation. What is appearing?
It's not your one.
No, not sir.
Then click on the button.
029.
Okay. You go to the button called present at the bottom, next to the mic icon.
Okay.
Click there and go to manage content.
Okay.
Then go to your scroll to your presentation there.
Okay.
And there is an icon at first icon there. Click on there is a square type of icon at the beginning, right? Click on that.
Open. Is it?
Open, yes.
Open button.
Isn't it opening your file there? No?
Hold on.
Okay, wait, then we'll upload the presentation.
No. Okay, sir.
Okay, now you take over as the presenter and start presentation.
I have selected investment property industry for the analyzing the project proposal. That is renting down business spaces. Hello?
Hello, yes, yes. Yeah.
Hello?
Yeah. Go
Can
ahead.
you hear me, sir?
Yeah. So we are
Yeah.
listening.
The initial investment initial investment is assumed as 1 billion.
Okay.
That is for the land and building. It is assumed to construct 11 floors for the building and 3 for car parking and other 8 floors to be rent out. Square feet per floor is 4,400. Rate per square feet is 110 hypothetical value. 1 year is assumed to be taken to construct, and fixed cost has been assumed as 2 million per annum. Then I have prepared the pro forma income statement. With that, sales of year 1 has been taken as 110 per square feet, 4,400 square feet, and for 8 floors into 12 months. It is 46 million, and it has been assumed 10% increase of the rate per square feet over next 5 years, and variable cost has been assumed as 50 per square feet. With that, I got the gross profit of 17 million in year 1, and it has been increased to 581 million in year 2 likewise. Fixed, as I explained earlier, 2 million has been assumed as fixed cost, and the building value, that is 800 million, has been depreciated over 15 years. The company policy has been estimated as the 15 years as the company policy for depreciation. With that, in the first year, earning before interest and tax is 37.9 million loss, and 2 year 529 likewise. Interest is assumed that I have explained in next slides also capital structure. From that 1 billion project, 800 million has been taken as a loan at the rate of 12%, so that interest is 96 million over the period. It has been assumed that no capital repayment during 5 years. After that, full 800 million will be settled. With that, profit before tax is actually it is a loss in the year 1. It is 133 million, 430 million in year 2 likewise. Tax is assumed as corporate tax rate 28%, and it is assumed as no change in the tax rate in future 5 years also. With that, loss of the company is 96 million in the year 1, year 2 309 likewise. Pro forma balance sheet has been prepared as follows. Land is 200 million, Building 800 million has been depreciated over 15 years. Cash balance has been arrived by adding back depreciation. And loan, as explained earlier, no capital payment for the loan and will be full in the 6th year using the excess funds of the company. And the company proposed capital structure of the company is equity 200 million, that is for the land value of the land value of the project, and full building cost will be utilized using debt borrowed funds, and equity can hypothetically assumed as 14%, and debt capital is assumed as 12%. The prevailing AWPLR is 11.37, and the policymakers has been suggested that the AWPL and the borrowing rates will be reduced in future periods, so that 12% debt interest rate has been used for the calculations and has been used the tax shield 28%, and weighted average cost of capital is 9.71. With that, for that, I have adjusted the risk premium of 20% for the WACC calculation to arrive the discounted discounting rate. For that, I have used the figures information of Overseas Realty Ceylon PLC company. As we can see in this slide, profit after tax of the company, there is a small variation of the profit variability of the profit after tax of the company in the year of 2013 and 2012 when we compare in the history of the last 5 years of the company. So with that, an Overseas Realty company is a well-established company, but this project is not that, so it takes much time for this proposed building also to grow up. Likewise, take that Overseas Realty company, so that it has been as 20% upward has been adjusted to reflect the risk of the company to the weighted average cost of capital. With that, I have used the cost of capital 11.65 to discount the cash flows. Net operating cash flow, as explained earlier, also has been calculated as added back depreciation and deducted tax to the earning before interest and tax, and projected cash flows has been assumed likewise. When doing the calculation part to assess the viability of the project, payback by the results of payback period, by 2 years and 11.7 months, project will be recover, and using the net present value discounting at 11.65, what is calculated back in previous slide, it is positive 471 million, and IRR, that is the rate at which the NPV becomes zero, is 26 million. Here, to get the negative cash flow for the IRR purpose, negative net present value for the IRR purpose, it has been discounted at 28%, and using normal WACC, it is 11.65. By applying these figures to the formula, I got the IRR value of 26%, which is higher than the weighted average cost of capital, cost of the project. So using the above calculations, that is payback period is 2 years and 11 months, positive NPV, and IRR is higher than the cost of the project. So I can recommend to accept the project. Thank you, sir.
Okay, thank you very much. And then this one with regard to the investment property, am I right?
Yes, sir.
Right. Now your anyway, the plus point is that your cost of capital calculation is okay. And then this
Okay.
where here this pro forma income statement, if we refer
Okay.
profit after tax, so that you have obtained, and then where is the, according to that our what is called the theory that we have discussed, where that you have shown the, yeah, here net operating cash flows, am I right? So EBIT
Yeah.
that you have taken plus depreciation minus tax. So
Yeah.
then thereafter you have obtained operating projected cash flows, right? Okay.
Yeah.
So this is correct methodology you have applied. Net operating cash flows, then initial investment, right? So then net operating cash flows. First year 52 million, right? Then payback analysis.
And did you say that this project ran for 15 years and you assume that depreciation?
No, ma'am. The cash flows has been assumed only for 5 years,
5 years.
but as per the company policy, I assume the company policy for depreciation, it has been depreciated over 15 years.
Yeah, project period is 5 years.
Yeah.
What is justification for 5 years?
Actually, I used the forecasted cash flows for 5 years to analyze the project viable. With these results, actual payback period is almost nearly 3 years, and a positive NPV. With that, before 5 years, it can recover the project.
No, that's okay.
Rather than exceeding to 15 years.
Now tell me again in your words, how did you calculate, that the income per year?
110
Okay.
rupees per square feet.
Okay.
8 floors to be rent out,
Okay.
and 4,400 square feet per floor
Okay.
in year 1, and it will be increased at 10% over the period.
10% over the period. How that, what?
No,
Square
normally
feet or price? Price per square feet or square feet? Square feet cannot be increased.
no price. The 110 will be increased by 10% in
What?
year 2.
Rate per square feet
In the
is
first
rupees
year,
110.
110, it will become
Okay.
uh,
Okay, right. So 10% year on year increasing.
year on year increase.
Tell in that way. We have to provide the answers, no? Right. Now, right. According to your presentation, there are no questions, that because you have, that anyway, organize slides very well. Right?
Okay, sir.
Okay, thank you very much.
Thank you, sir.
Okay.
Any more to present?
Anybody to present? Presence unknown. No presenters further? Only you know that 4 presentations today? Hmm? Kera. Bandara region. Region bandara kena klik. Cepat. Minta. Submission of the assignment, so that we will extend the Dropbox to next week as well. You submit your that assignment to the Dropbox, and that you must be prepared for the presentation. Anyway, that we have noticed that there are 7 submitted assignments to the Dropbox, but only came online only for 4 presentations. Yeah, that. So it's compulsory either online or in physical presence that you need to make a presentation, because without presentation you will not get full marks. So mere submission of the assignment to the Dropbox will not that award all marks. So therefore that you need to justify why. So you can go for plagiarism, where that internet based project analysis you can copy and you can paste and then you can upload. So blindly, so we as examiners will not allocate marks for those that assignment submissions. Okay, so we will conclude from here.